Hello, I'm Bill Wilt, and thanks for listening to this audio summary of our February 2026 assured briefing. I'll provide you with a brief summary of the notes in this month's briefing, and I hope you'll find time to read or skim the content as well. We always include lots of graphs which supplement our work, but they can't always easily be captured in an audio summary. So consider that a suggestion to run your eyes over the document as well. Now, if cars with advanced safety features represent nearly 100% of the auto fleet by 2050, what will that mean for auto insurers and the composition of the industry? That's the topic of our first note, where we offer three future scenarios for auto liability insurance. As a backdrop, keep in mind that the number of auto bodily injury claims in the industry has been roughly flat at about 18 million per year for the past 30 years. Now, in scenario one, we envision that auto liability claims could remain flat. And throughout all of this, we're looking through the year 2050. They could remain flat over much of the next 25 years, just like they have over the past 30. In that case, premium might grow at about the same 4% per annum level as for much of the past 30 years, which might in turn be characterized as compensating for economic growth plus inflation and a small litigation kicker. Auto consolidation has been a driving force over the past 30 years, certainly, but perhaps in this scenario over the next 25, it slows and smaller auto insurers can keep on keeping on. Now, it'll be a bit tough to visualize in this audio summary, but in the note, we describe various assumptions regarding the S curve that illustrates the growth in cars with advanced safety features. You may know that cars with advanced safety features, as estimated by work from the Insurance Information Institute and the Highway Loss Data Institute, show that occupants of cars with advanced safety features are some 30% less likely to have a claim with a bodily injury feature. Importantly, in the note we describe and personally believers in the network effect, which means that there's a compounding safety benefit as cars with advanced safety features proliferate and everyone becomes safer because the cars around you are safer as well. So those graphs are in the note, but what I'd say in scenario two, which we deem to be a middle of the road scenario, auto BI claims could decrease by 10 to 15% cumulatively through 2050. Now, we're talking about auto BI claims, and in this scenario, it seems highly probable that market share consolidation would continue and premium growth would begin to slow as accident rates moderate. Now, we call scenario three the workers' compensation scenario because annual claims could decrease cumulatively by 20% or potentially much more through 2050 if the network effect proves even more consequential than, say, we might have currently envisioned. In this scenario, we'd also expect more consolidation, and in this case, stagnant to slowing and decelerating premium growth. We referenced workers' comp here because although it can be hard to believe, there's been like a 60% decline in workers' compensation claims over the last 30 years, annual workers' compensation claims. So in two of the three future scenarios that we contemplate, we'd expect more consolidation and slowing to stagnating auto premium growth in the private passenger auto liability sector. And you might find it interesting to review the one-page addendum to this note, which shows the impact of the proliferation of cars with advanced safety features, or the more specifically, the rate at which those are adopted. That is the S curve that we described previously, and we're now really in the accelerating phase, or the steep part of that S curve, where current estimates are that something like 30% of the auto fleet currently has some combination of advanced safety features. That's going to rise to something like 80% is the current estimate by the late 2030s. So just around 10 years, we have a really substantial increase. And for what it's worth, the math points to the year 2029. Our math does, as the year with the sharpest decline in auto BI claims. Now let's turn to our second note, which is an examination of shareholder returns based on the manner in which companies return capital to shareholders. We can really summarize this succinctly by saying that the form of capital return does not appear to impact share performance. Asked and answered another way, have companies favoring one method of returning capital to shareholders, whether common or special dividends or share repurchases, has one group outperformed the other? The answer is no. In the interest of time, we'll leave it at that conclusion and invite you to review the work. Now, in our third large note, we examine the impact on property casualty insurers of a K-shaped commercial or business economy. Many of you will know or have read articles that describe the K-shaped consumer economy, with those people of higher net worth and stable or rising incomes on the upper arm of the K. They're still spending money, and those on the lower arm of the K are those with less savings, lower or uncertain income streams, and they're starting to become much more careful about their discretionary spending. Now, it turns out that the K shape also describes the employment markets, with companies at 500 or more employees hiring throughout 2025, while smaller employers of fewer than 50 employees didn't, and they actually lost employees. And of course, somewhere in the middle were employees of those between 50 and 500 employment size companies. So here are the important takeaways. Small commercial companies purchase more commercial insurance than either the middle market or large employers at 230 billion for small, 157 billion for mid-market, and 128 billion estimated 2026 commercial premiums for the large commercial employers. And that data, by the way, comes with thanks to Verisk's Market Stance business unit. Uh, another bit for you. Small commercial firms purchase notably more diverse insurance products, while liability covers are the main purchases made by the mid-market and large commercial purchasers. We looked across the country in the commercial insurance landscape and examined premium distributions in relation to the distribution of the US population, and can share that Florida is the most overweight in small commercial premiums, remembering that's already adjusted for their large population, and California and New Jersey are top states for both small and middle market premiums. New York, again, even after adjusting for its large size, is a leader by premium size across all three market segments. And I've got to recognize here that premium volume is also influenced by the high cost of doing business in several of the states I mentioned. To give you a few more takeaways, we'd say that in a K-shaped business environment, the insurance partners of large corporations are surely going to benefit if they continue to grow and hire. But what one has to recognize is that those firms are also best equipped to self-insure, and they have a relatively more elastic demand function than small firms. And while the relatively inelastic demand function of small firms probably means that premium growth would decelerate more slowly than employee growth, it's still not clearly good for the economy if employers with fewer than 50 employees aren't doing well. After all, they account for 44% of the workforce and purchase nearly half of commercial insurance premiums. So that's it. Our briefing does contain two other very short notes, but let's leave the audio summary at this. I'll thank you for your time and interest in our work. Please remember that in most cases, your colleagues are welcome to join us and to join our distribution list. And all you need to do is send them to the Contact Us page at our website, where they can complete a form and join. Hope you have a great rest of your day, and thanks again for your interest in our work.